Our problem for Chapter 11, our first problem anyway, is going to be 11-1B, which is on page 529 of your textbook. We're going to look at transactions that have to do with liabilities. The following items were selected from among the transactions completed by Aston Martin Inc. during the current year. And there are some of our transactions. And if we turn the page, there's more transactions at the top. Our instructions: number 1, journalize the transactions. Number 2, journalize the adjusting entry for the following transactions. So we're going to go back to the page before it and start with our first transaction. Our first transaction states that on April 15th, we borrowed $225,000 from Audi Company, issuing a 30-day 6% note for that amount. Okay. So in your step-by-step that you should have gotten off of the portal, we have a journal page. So we're going to stick the letter B here because we're doing 11-1B. We're going to start with our date, which is April 15th, 2014. We are borrowing money, so we're receiving cash. We received $225,000. We have to pay that money back, and we borrowed it in a form of a notes payable. We're going to put Audi Company so we know where the money came from. And we're going to credit notes payable for $225,000 because we now owe them that amount. The other information in the transaction, the 30-day 6%, we're going to use that when we make our payments on this notes payable. The next one, May 1st, purchased equipment by issuing a $320,000 180-day note to Spider Manufacturing Company, which discounted the note at a rate of 6%. And the word discounted right here is something we need to know. We learned during the PowerPoint that if a note is discounted, it means the interest is taken off of the amount of money that you actually receive. So we're going to go ahead into our journal, and our date is May 1st. Now in this case we did not receive cash, we purchased equipment. So equipment will be our debit. We did not receive $320,000 worth of equipment because our note is discounted. This is where you're going to need a calculator or a piece of paper. We're going to take the $320,000 and we're going to multiply that by 6% and also by 180 divided by 360. Whenever we're trying to figure out interest, we're always going to use principal times rate times time. Okay, PRT. And this is going to give us our interest. Again, principal times rate times time. Your time is always divided by 360. Okay, we use a 360-day year. So we're going to grab our calculators and we're going to figure that out. And it turns out that our interest is $9,600. Okay. So then we're going to take our $320,000 minus our $9,600, or we're going to get $310,400. Whoops, sorry. This is going to be the number that we're going to use. This is our principal, this is our interest, and this is how much equipment we actually received, $310,400. So we're going to come back to our journal. We're going to debit equipment for $310,400. We're also going to debit interest expense for the $9,600. And we're going to credit our notes payable Spider Manufacturing. For the full $320,000. Okay. We borrowed $320,000. $9,600 of it was interest. $310,400 of it was principal that went into our equipment. The next transaction in our book, on May 15th, we paid Audi Company the interest due on the note of April 15th and renewed the loan by issuing a new 60-day 8% note for $225,000. Record both the debit and the credit to the notes payable account. Okay. So we're going to start with our date, which is the 15th. The first thing it tells us is that we paid the interest due, and then we renewed the note. When they say we renewed the note, we kind of paid off the old one and then took out a new one, all in the same transaction. So the first thing we're going to do is pay off the old one. If we look up here, notes payable was credited for $225,000. So the first thing we're going to do is debit it for the same amount to show that we've paid this one off. The next thing we're going to do is calculate our interest. So we're going to grab our scrap paper here. Whoops, let me just draw a line. Here we're talking about $225,000, which is our principal, times our rate, which was 6%, times our time, which was a 30-day note. And that gives us our interest. And once you grab your calculator and figure that out, the interest comes out to be $1,125. These numbers, the 6% 30-day, came from the transaction on April 15th. There was a 30-day 6% note on April 15th. Okay, those are the numbers we're going to use to calculate our interest. So in our journal, we're going to debit interest expense for $1,125. Now the transaction says that we paid for the interest on it, so we're going to credit cash for $1,125 because we paid the interest on our note. We also then renewed the note, which means we took the money out again, so we're going to credit notes payable Audi Company for the $225,000. Now, why did we debit it and then credit it again? The reason behind doing this, because it all evens out in the end, but the reason why we put this in our journal like this is to show that it was renewed, to show that it's not the same loan from April 15th, that it's a new loan. Okay. If we didn't put in the debit and the credit transaction here, then it would look like we still have the same loan from April 15th, when in actuality, it's a totally different loan with a totally different interest rate. Excuse me. The next one in our book, July 14th, paid Audi Company the amount due on the note of May 15th. Okay. So it is now July 14th. And now we're paying this note off, this bottom one, this 225 note. So we're going to have notes payable, Audi Company. And we're going to debit that for $225,000 to take it out of our journal. And now we have to calculate more interest. I'm going to draw another line here on my scrap paper. I don't draw straight lines very well. So now we have the $225,000, which is our principal, times a rate of 8%, times time of 60 days over 360. And this gives us interest of $3,000. That really is a 3, I promise. Okay, this rate and time came from the transaction in our textbooks of May 15th. So in our journal, we're going to debit interest expense for $3,000. Then we're going to credit cash. We're paying this loan off, so we're going to credit cash for the total of $228,000. Okay, on the next page in your book, the top of the next page, we have our next transaction. August 16th, we purchased merchandise on account from Exige Company, $90,000, terms net 30. Okay, purchase merchandise on account. We're not doing any long-term borrowing here. It's more of a short-term. It is August 16th. We purchased merchandise, so we're going to debit merchandise inventory. For $90,000. And we're going to credit accounts payable. And then the company name. And we're going to credit that for $90,000. So this is just a basic purchase merchandise on account. The next one, September 15th, issued a 45-day 6% note for $90,000 to Exige on account. So now we're taking our accounts payable from August 16th and turning it into a notes payable. Okay? So in our journal, it is now September 15th. We're going to debit accounts payable to take it out of that account for $90,000. And we're going to credit notes payable, Exige Company, for $90,000. So all we did was take it out of the accounts payable account and put it into the notes payable account. So we turned it from a short-term loan into a long-term loan. The next one, on October 28th, we paid Spider Manufacturing the amount due on the note of May 1st. Now, if you remember, the note of May 1st was a discounted note. So we took care of the interest up here on May 1st. We've already dealt with the interest. So we don't have to do that in this journal entry. We're going to fill in the date, which was October 28th. We paid off the note, so we're going to debit notes payable, Spider Manufacturing, for the $320,000, and we paid it off, so we're going to credit cash for $320,000. The next one in our book, October 30th, we paid Exige Company the amount owed on the note of September 15th. Okay, so we're paying off another note. It is now October 30th. We're going to debit notes payable, Exige Company, for $90,000. We're going to grab our scrap paper and calculate out the interest. So we have $90,000, which is our principal, times 6%, which is our rate, times 45 over 360, which is our time, and we get interest of $675. So in our journal, we're going to debit interest expense for $675. Now we paid this off, so we're going to credit cash for $90,675. Remember, our debits always have to equal our credits. The next one in our book, November 16th, we purchased store equipment from Gallardo Company for $450,000. paying $50,000, and issuing a series of 29% notes for $20,000 each, coming due at 30-day intervals. Okay? So, in other words, every 30 days, we're going to pay them $20,000. So, in our journal, we're going to start with the date. Always do the easy part first. It is November 16th. We received store equipment. So we're debiting store equipment for $450,000. We're paying $50,000 cash, so we're crediting cash for $50,000. And then we have a notes payable. We are not going to list this 20 different times. We're going to put it all together. Notes payable, Gallardo Company, $400,000. Okay. No matter when they're due, it's still $400,000 that we owe them. Okay. The next transaction, December 16th, paid the amount due Gallardo Company on the first note in the series that was issued on November 16th. Okay, so it is now December 16th. We're going to debit notes payable, because we no longer owe them $20,000. We're paying on the first note in that series of 20. Then we have to calculate our interest. So we have a $20,000 note. Times 9%. Times 30 days. Gives us an interest of $150. Principal times rate times time. So we're going to debit interest expense. For that $150. We're paying them, so we're going to credit cash for $20,150. Now, each time you pay off one of those series of notes, you're going to do the same thing. The last transaction that's listed in our book for instruction number 1 says settled a personal injury lawsuit with a customer for $87,500 to be paid in January. Aston Martin Inc. accrued the loss in a litigation claims payable account. Okay, in this case, we're going to use that litigation claims payable account. It is December 28th. Okay. We're going to start with the words litigation loss is the first account we're going to use. We're going to debit litigation loss for the $87,500. Now, we have not paid it yet, so we're going to credit litigation claims payable. For the $87,500. Okay, the next step in our book tells us to journalize the adjusting entry for each of the following accrued expenses at the end of the current year. And we have two adjustments here. The first one is product warranty costs, and the second one is for the interest on the 19 remaining notes. Okay, so it is the end of the year, and we're going to be doing our adjusting entries. On the next page of your step-by-step, you know what we didn't do? Top of our journal, this is page 1. On the next page of your step-by-step should be another journal. We're going to make this be page 2. We're going to center the words adjusting entries. Okay, our date is December 31st because it is the end of the year, 2014. Our first adjusting entry is for product warranty costs. So we're going to debit the expense. So it's going to be product warranty expense. And we're going to debit the expense for the $26,800. And then product warranty payable is going to be your credit. Not something we've paid yet, something we will have to pay in the next year. And that's going to be your credit for $26,800. The next adjusting entry, we put in the date of the 31st. The next adjusting entry is for the remaining notes that's owed, for the interest on the remaining notes. Now, we have to calculate that. We are going to look at this. We're going to take $20,000 times your rate times your time. We're now looking at 45 days over 360. And then multiply this by 19 because that's how many notes we have left to pay on. And your interest is going to be $42.75. Okay, so principal times rate times time times 19 notes gives us an interest of $4,275. So our journal entry is going to be interest expense a debit for $4,275 and then interest payable. Is going to be your credit for $4,275. And those are your two adjusting entries. At this point, go ahead and turn off the video and head back into your PowerPoint.